Well, as promised, let's get that conversation going with Daniel Morris, Chief Market Strategist and co-head of the Investment Insight Center at BNP Paribas Asset Management. Daniel, thank you so much for being here with us. It's great to have you in person. The world has been a very interesting place, to say the least, over the last month and a half. So let's start by understanding, I mean, at your level, when you talk about asset class calls in markets around the world, there was the love everything America move, then there was let's go away from America move, then whether you want to go to India or China. So just give us a top-down view of the investment call and the framework that you're working with right now.
Yeah, well, the contrast between the very much everything in U.S. equities that you felt after the election. And, imagine if someone had come to you then on this show and said, no, forget America, you should buy China or you should buy Europe. You probably would have escorted them quickly out of the studio. But that's turned out to be the right call. I think what's perhaps a bit healthier today is it is much more balanced. So we're modestly overweight equities, so we do think it's a positive outlook. But honestly, no geographic call today. It's not obvious any particular region or country that you'd have a high level of confidence that that's likely to outperform or for whatever period. So we're pretty neutral geographically right now. As always, wait to see what develops to see if there's something that looks more appealing.
You said you're only moderately overweight on equities.
Yeah.
So you're cautious overall. So just run us through that.
Well, there's still, you hate to say it, but plenty of uncertainty. So to have a view where you really would want to be very overweight equities, we wouldn't think would be prudent. I mean, we're really still, and will be, honestly, for probably a couple of months yet, assessing what the macroeconomic impact on growth is going to be of the tariffs. Many scenarios we can discuss, but since we don't really know which one's going to play out, having a high conviction call we think right now is not appropriate.
Any anti-consensus views, Daniel?
Well, to be honest, even being modestly overweight equities could arguably be anti-consensus. There's still plenty of people that think you're going to have, or certainly the risk that you're going to have a much more significant slowdown. At least in the U.S., people do still talk of a recession, even if hopefully the odds of that have fallen. We have to see what the actual impact on inflation is. And the other thing to keep in mind here, without question, the tariffs are going to be negative for growth in the short term. But that's happening in a context where growth in the U.S., at least, was already slowing for other reasons. Remember, we talked about a soft landing as a scenario for the U.S. before the election, which meant that consumer demand was going to slow and growth would fall. That's actually probably happening anyway. And then you add the tariff shock. It's a bit unsettling when you try to forecast what's going to happen with growth.
With China, the view is that maybe we've seen they have some sort of a handshake deal for now, and then we'll get probably like a MOU and then probably a deal later. But even back in 2018, China actually started slowing down when those first set of tariffs, etc., were imposed. I'm asking this in the context of India, because generally, if you read the press, if you read, the view is China has come out on top. With regards to negotiations with, they've not given in very much, and they've been able to reduce tariffs to 30%. Is that? Would you agree with that, Daniel? Or you think we will see another leg of slowdown in the? Look at what happened in 2018, and this is much bigger.
Yeah, I probably have a slightly different view of what's occurred in terms of the reductions we've had. I think the initially very high tariffs, the objective was to get to the negotiations. The idea was not to leave them there permanently. So the fact that they've been reduced, well, is because we're negotiating. So from that point of view, I don't know that I see that's the case. But ultimately, it's going to come down to what the agreement is. And I don't think anyone assumes it's going to be an easy discussion. I think, not only with the negotiations with China, but essentially with all the U.S. trading partners, what the U.S. wants to see is a reduction in tariff levels vis-a-vis the U.S. And, ultimately we have to see how successful that is, and then we can assess whether or not it turned out to be worth all the turmoil that we've gone through or not.
On tariffs, yesterday, President Trump made a very interesting statement. It was picked up widely by everyone in India. I know you know what I'm talking about, right? He's calling up Tim Cook and saying, don't make phones in India for the U.S. How do you think, this is an example I'm picking up, how do you think this is going to play out in terms of corporate America sentiment? And again, I go back to the main question that I think this is why you're not too optimistic on equities. But what are you pricing in, for the rest of the year, say, in the U.S. market or any of the other regional markets that you may like?
Well, I think when you think about, people discuss what are the risks to growth, and one of the points that people highlight is uncertainty. So supposedly we're also uncertain about exactly what's going to happen, and therefore you're worried about the impact of that on growth. But I think one thing is pretty certain, which is you are going to have tariffs in the U.S. And the point then is it's a clear message to businesses that if you want to avoid those tariffs, you want to produce in the U.S. So regardless of whatever statements you might hear from the administration, any company is going to be evaluating, I can produce or attempt to produce more in the U.S. And therefore avoid the tariffs. And if I produce elsewhere and import, there is going to be a cost. So it's going to be ultimately a financial assessment that every company is going to make as they should.
So as investors, what is your overall portfolio architecture? I mean, you're saying moderately positive on equities. So what else? I mean, do you like treasuries? Are you advocating a bigger shift towards gold? So what's the portfolio call at this point, given the environment?
I guess two key positions to mention outside of equity. So within fixed income, the view is a relative preference for European fixed income versus the U.S. I mean, to be honest, it's relative. I would say simple. But in Europe, it's a bit more clear in that you are certainly going to have lower growth because of the tariffs. Tariffs are going to likely to reduce inflation in the Eurozone. You worry about an increase of Chinese exports to Europe to offset the U.S. All of that negative for inflation, or at least bringing inflation down. And then, of course, the ECB is cutting rates and the Fed is not. So it all suggests that on a relative basis, you would have a preference for European fixed income, which we do. And then we still have a modest preference for gold. We had a much bigger one previously, but needless to say, gold has moved a lot. So not quite so optimistic about the future, but nonetheless, the two key drivers of the performance of gold over the last 18 months, number one, central bank reallocation of portfolios from treasuries to gold. That's likely to continue. And if you can call it the Trump premium in gold prices, that's probably going to stay, even if, all the volatility that we expect around it, but not likely to disappear either.
A great conversation, Daniel. Thank you very much for dropping by. It's a pleasure having you here.
Thank you.